Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, September 12th, 2023. It's 1:20 p.m. Eastern Time as I'm starting the video, and I'm going to go through the following in this order. We're going to look at the equity markets first, then we'll follow into a couple sectors, and as well as some other trade ideas right now. So we're going to start out with the major indexes, semiconductors, financials, new trade idea on palladium, updates on natural gas, crude oil, commodities in general, and wheat. That's some of those the individual commodities I've been focused on lately. All right, let's start out here with the NASDAQ 100 and just take a quick look at it. So I had this downtrend line here. I'm going to go to my clean board. This is what I call my busy board. Key levels are still marked in red. I've shared this quite a bit. So you have this red uptrend line right here off the late December lows right there, really, the 2023 uptrend line. And then you also have what I still believe to be a pretty significant level, the lows from August 18th right there. Now, let me say this. If you're frustrated that you're not making a lot of money, especially trading the indexes, well, welcome to the club. I've always said this. The stock markets are not like an ATM that you can go up to and extract money on a daily basis. Now, there's certainly other areas to be making money and have been lately, and that's why I always will cover individual sectors, commodities. But as far as the broad markets go, here's where we were. We'll turn off all the lines. This was mid-June right here when we peaked. We're trading right now where we were on the mid-June high in QQQ, and it's similar on the S&P 500. So that is, we're now in September. So there's 3 months of completely sideways action. You can just circle it there. It's not hard to see. Again, let me grab this little circle tool. This is our trading range, and that's where there's the midpoint line. So we went below it, we went above it, we went below it, we went above it, and we're right on there. So that's it. So, we say there's a lot of sayings I make up in trading the markets, and one of those is if in life, patience is a virtue. We've all heard that saying, and I say in trading or investing, patience is a must. It's not an option. So that's it. So, what do you do with that? You go, fry some better fish elsewhere, individual sectors, stocks. That's what I'm going to get to here in a second. But I always keep an eye on the broad market. This doesn't last forever. We get in these trading ranges, and sometimes they go for a while and then they break out. But from such ranges will emerge the next tradable trend, and that's where swing and trend traders will again have an opportunity to profit. I'm going to go to my clean board here. That was my busy board. This is my more of a clean board, fewer lines. And again, you have the same uptrend line right there. And what I've done is I removed that downtrend line off the highs. If anything, we might get another reaction here. We only have 2 reactions the way I draw it here, so I'm not really putting a lot of weighting on it right now, and I'm referring to that other one I had back here because we sliced through it. When we slice through a trend line, if it's well defined, I'll allow 1 or 2 violations, but when you go through it like it's not even there, then that line's really not significant anymore. So I'm going to take that away on that board. I just wanted to mention that. So at this point, nothing's changed for weeks or months now until we take out those lows from August 18th. I'm talking about since the day after them. That's there's still the possibility or the potential, a decent potential, to see that marginal new high scenario. So this is where I can first of all, the red break of the uptrend line would significantly decrease the odds of that marginal new high scenario where we go up, put in a larger divergent high, and then reverse. And of course, I think a break below that August 18th low would help seal the deal. So that's what it looks like in QQQ. Maybe a little triangle if you come off the highs like that. But again, those are levels. I have price alerts set, and I'll update you if and when they break. So let's not try to overanalyze that. This is my clean board on SPY, the S&P 500 tracking ETF. Back here, you had divergent low right there, big positive divergence at the low, and a bullish engulfing candle back in mid-October. That big green candle right there, which engulfed the previous candle, or candles, several of them actually. came full circle all the way up here on the rally. After that, bearish and bullish engulfing candles typically marked a turn, a bottom in the market, a major inflection point, or had the potential to, and that one certainly did. Then we put in a bearish engulfing candle on July 27th right here, which so far has marked the high in the S&P 500, and nothing's changed. It's still my primary scenario, both in QQQ and SPY, that those recent highs were the highs. We're not far from them, and again, work to be done. There's my the August 18th low right there is about 433 on SPY. That's that big level. But again, I have it marked red because that needs to go. And then you had several uptrend lines. We've had the minor trend line that gave us that wedge, broke down. We had a sell signal there, and we've been moving lower since. So if you turn off all the lines, again, these are the important levels down below. But if you turn off all the lines like this, so far, again, it's early, but we do have the early makings of a potential downtrend. We really need to stay, I'll tell you, below this recent high, those spike highs on SPY and QQQ, because that's going to chip away. It's not going to eliminate, but it's going to increase the odds that we're going to see that marginal new high scenario. But again, the equity indexes, there's just not a lot of opportunity right now. I still think the RR is skewed to the downside, favors there. But again, as I've been saying, work to be done. We have to take out those levels below to increase the odds that we are going to have another leg down, a much bigger drop. Otherwise, we may see that marginal new high, and that could carry over. Hard to say when. Probably into almost certainly into October. Right there, let's just say if we get that scenario, possibly maybe into November. On a quick update here, somebody brought up yesterday the chart that I've been posting on the NASDAQ 100, the 120-minute chart on the futures. And up until today, the charting platform I was using there hadn't yet, even though most futures traders had started to roll in this week, the charting platform itself hadn't identified the December contract, which is now the most liquid contract, as the continuous. So until they do, then I can't, the charts really, you can chart the Decembers, but it's spotty because they show you all the history on the actual contract. If you don't know what I'm talking about, don't worry about it. But this is now recognized as the continuous. So what I did is I updated this. I just wanted to mention, as futures roll, you're going to have different levels anyways. And so now these are the new levels. I tweaked them a little bit, but this is really probably the next, it is the next downside target. We already checked this one up here. That's about 14,690. Maybe I'd pull that line down. Yeah, let me do that now for you, because we have two reaction lows there. Call it 14,613 right there. And then all the way down here, next stop, minor support about 1445, and then 13,626, which is kind of a intermediate downside target should we fail. There's that downtrend line, which is still very much intact on the futures. That's what I was talking about and showing you yesterday. And so we have a lot of clean reactions, 1, 2, well, several there, but we'll just call that 2. It's a distinct point. Tested it for a while there, 3, and then another reaction recently. The continuous is right here right now. When they first roll it, you got a funky candle with an extra tail that really shouldn't be there. So we're right there right now under the trend line. So we have the potential to pop it. And again, by popping it, it's only going to, even though we have divergence in place, so I had this chart marked up, but I have to remark it. Sometimes these lines just seem to disappear on me. So there's the divergence that's been building for quite a while, and would continue to be there should we break above here anytime soon and put in a marginal new high. Again, assuming it's only a marginal new high. Somebody asked, well, can we not have a new high with it's a big new high, 10% plus? Absolutely. It's not what I think is going to happen. If it happens, I'm dead wrong right now. I'll try to adjust at the time, but at best, that is my alternative and still most bullish of my two bearish scenarios that say we're going a lot lower. It's just, are we going to go a little higher first, pop that, 2, 3, 4, maybe 5, 6% above the previous high, and then reverse. Again, it will keep the divergence in place on the daily charts, the weekly charts, and here on this 120-minute chart, if that were to happen. But it would have to happen soon. Depends how it happens. You have to predict where prices are going to be and where the indicators are going to be at that time. But the takeaway, and then we'll get away from the equity markets. Resistance is resistance until unless taken out. So there it is. There's resistance. Take it out. It's probably going to bring in some buying, buy programs, short covering, and all that good stuff. And on a very related note to the NASDAQ 100 is SOX, Semiconductor Index. Beautiful trend line. Let me flip, see if I have a clean board. Nope, but I can make one for you right now. This is it. This is that primary uptrend line off the lows right there. It's nice and clean, well-defined. What I mean by that, no violations. There's the mid-October lows. You got some reactions in here. Been testing it lately, and we're right on the line. As I like to say, support is support until unless broken. So that is a big one. When that goes, unless it's anything but a whipsaw, then that's going to be a sell signal in the semis. It's probably going to put, will almost certainly put pressure on the tech sector if there's follow through to the downside. Again, this market's been plagued with whipsaws in recent years. It's just the way the game is played. The powers that be, the big algos, market makers, nefarious forces, whatever you want to call them, they know where the stops are. And if they can pull it down to suck in some shorts, that's why you have to almost anticipate or at least recognize if you get a false breakdown and then a recovery, then, the breakdown's bearish. It's a sell signal. You can add to or initiate a short on the semis. May not want to go super heavy until the indexes break some comparable supports. And then if you do short it, it's simple. So I don't want this to be confusing. Tell you, well, breakdown, it may be a breakdown, it may not. It is a breakdown unless it fails. And then when it fails, it starts moving up here, then that's where you realize, guess what? The breakout failed, or the breakdown failed. And I need to then, keep some pretty tight stops and get out of those positions. If it goes back below, you can always reshort. So that was your divergent high. And it's these divergence and all that say, what? This run, there's a good chance that this run is over because it ended with a divergent high, just like that run, just like this one down here ended with a divergent low. And so that puts the odds, in my opinion, that this trend line is going to give way sooner than later. And if we happen to make a marginal new high, just like the stock market, no big deal. We'll certainly have these, if it happens anytime soon, those same divergences that are currently in place will still be in place again if it happens anytime soon. It would look like that. Then you go on and break down, and then we'd be talking maybe October, November, December. We'll see. Financial sector. This is my busy board here. Let's see if I have a clean board. Nope, I've got fibs on that board. Let me take this fib off here, clean this board up. What you can see on my busy board there is it's basically is a triangle pattern here forming in the financials, a downtrend line. Not super well defined, but enough reactions to help validate it. And maybe you can come in and catch this one and say that one was a little false breakout, and we're right at the trend line now, give or take. Benefit of the doubt, you come in at that high right there. I won't go through each and every one, but I want to tell you there's a common theme I see in the financials. A couple common themes. Number one, big divergences on most of the leading financials. I'm not going to go through each and every one, just kind of paint a bigger picture. This was a big, giant, bearish rising wedge leading up to the 2021 highs in Visa, and that was followed by a bear market that ended with this divergent low, gave us this trend, which forms the same thing. Big old bearish rising wedge pattern defined by this uptrend line right here and this negative divergence on the top. And so I'm just going to rifle through the charts and just point that out. So I have alerts set on just about all of these, and what I suspect will happen, and I have a high degree of confidence it's going to happen. It's going to happen soon, within the next couple months here. Could be weeks, could be days, could be 3 months, early next year, somewhere in between there, these trend lines, especially as long as these divergences remain intact, which I suspect they will go. And they'll probably all go around the same time. There's going to be, remind me to show you the economic calendar. Well, let me remind myself to show you that. I took a screenshot today. A lot of stuff coming up this week. This week definitely has the potential to move things. So there it is. Trend line, negative divergence. JP Morgan, king of the big banks, already broke down. I've been highlighting this one recently. So far, that bear flag isn't playing out the way it should because we've had a snapback rally here. But that doesn't matter. It just eliminates that bear flag continuation pattern as that. But there's that very well-defined trend line, big divergent high, breakdown. And it just hit support the other day, 143.85. Nothing more, nothing less. Nothing goes down forever. Put in a divergent high here. You went down. You had kickback rallies along the way. Nothing, stocks like this, beloved, the biggest bank out there, isn't going to drop straight down. So far, it's been a pretty impulsive leg down. And again, we're below trend, well-defined trend line. I can't say much more than that other than this is the level it has to go. This was a lot of resistance right here. That was a big breakout. We're back testing that. Bullish case would have a successful breakout and a successful back test, go on to eliminate the divergences. That's the bullish case. And unless we take out this level with conviction, going to especially if we get down to my initial price target, that should help seal the deal in the breakdown. So I just want to say that one's already broken down, but similar technical posture. That's as I'm going through these all. MasterCard has nothing to do with JP Morgan Chase, but it had this triple top high breakout here. I often say breakouts that occur on overbought conditions down here on the RSI tells you you're overbought with negative divergence. That's what this is. They have a much higher failure rate. This is also a beautiful bearish rising wedge pattern complete with negative divergence. So what I'm looking at, guys, in the financial is one of the most bearish technical postures I've seen out there, especially in an important sector. And it just need that catalyst, that match to ignite it. And that catalyst would be these guys, at least the majority of these, breaking down below these well-defined uptrend lines, triggering sell signals. The fact that the leader, or one of the leaders, JP Morgan's already done so, that's certainly a yellow flag, but we haven't flipped to those red flags yet, as I was mentioning the other day. Yellow flags are caution flags, typically, generally, and red flags are warning. They're more significant than a yellow flag. So we still have yellow flags here in the sector. Red flags will be when we start to break down. On MasterCard, you want to see, when your wedge breaks, you're also going to have a failed breakout of that 1, 2, 3 triple top high there. It's just beautiful charts. Berkshire skirting the uptrend line. The divergence just continues to extend. Let's pull this line out a little more. And same old story. So you can see it there. Bank America flirting with this one's had some problems. We're at the bottom, closer to a 52-week or multi-year low than we are multi-year high, like a lot of other things. So watch that one down there. Wells Fargo just caught trendline support. So a lot of these financials just yesterday, the day before, hit support. And so when those support levels go, and like I said, I have price alerts on most of those. This one's flirting. You can probably tweak that line right about here. Yeah, it should be pulled up there. There it is, nice and tight. Well-defined uptrend line. Lots of reactions when I say well-defined. That's what makes it more significant, more technically valid. And again, like I like to say, support is support until unless broken. You're at price support plus uptrend line support. But when that goes and the rest of them go, S&P Global, look at that beautiful trend line coming off a big divergent high. Just go back and look at these things. Divergent high. Not there. Divergent high and island top, divergent high. And so we need to break that trend line to make this, so far it's had a healthy correction off that divergent high. But if we are in a bear market, as I believe with a lot more downside to come, then this is just the beginning and that's your next sell signal. So could go over each and every one, but there's no point. It's just so much of the same. That didn't mean to be there. That's an extra DH, I think. But you see it, divergent high right here, divergent high, where did we go? Drawing tool, divergent high, divergent low, divergent high, and a key trend line, which we're at right now. So we either, rally off this trend line, whether we break it tomorrow, again, next week, next month. I have alerts set on just about all of these. Goldman, same beautiful uptrend line. Schwab, uptrend line, downtrend line. All right, let me move on. Give you guys a couple other things to look at. That is XLF and my top components. Palladium starting to look interesting. PLLs, an ETF, holds physical palladium. And we've traded this one many times over the years. This was a divergent low, bullish. We had a short right there, nailed that short, wrote it down. Divergent low caused this rally, which ended with a blow off top. Then you had this nice little bullish falling wedge pattern, complete with what I love to see, that positive divergence, rally, broke this downtrend line. Since then, we've been in a downtrend. We had a trend line there. We've been building divergence. This was a divergent low, as is this. This divergence has been building. There's big divergence here, and this is a trend line that'll probably do the trick. So if we can go up much more, we should break out. I haven't updated any of these horizontal levels. These are old lines on the charts, but I'm going to say initial target zone is going to be up here about 123 up to about 126. And again, I'll have to update that. But if it could get some, based on the scope of this pattern, I think we can work our way up there at least at 150, 185 if the breakout, is confirmed on volume, looking good. And that'd be about a 32% run. So there's one potential trade idea for you. Natural gas, I threw out last week, or was it earlier this week? Right here at the bottom of this trading range. And I said, I believe we are either just on it or even a little above it, but I said, or below it. I said you almost have to expect and allow for a little dip down below there. I'll show it to you on the 60-minute chart. So far, a nice reversal. And again, the story on natural gas has been put in back here, big divergent low on the daily chart. And when we zoom in, this is where I think I gave it to you on the 60-minute chart. So there's that divergent low that I just showed you on the daily. And we keep, we put in right here, divergent low. And this was the level right here. It's been choppy, and it's the nature of natural gas. So like I said, you almost have to expect or allow for a little bit of room down below support, especially when you have divergences. And it's not on fire, but it's been moving up since that recent divergent low. It's up about 11%. And the MO, when you recognize a trading range, it's not a super well-defined one because of the volatility in natural gas, but if this is the range that I just boxed in now, there's the top of the range. That would take us up to at least 738. And if we can ultimately break out, remember, we had an initial trade back here, somewhere off that divergent low, hit my first target, hit my second target there, pulled back. And so logically now, it would take us up to my third target and potentially fourth target right there. The other takeaway on this is that natural gas is obviously it's not as significant as crude oil as far as inflation goes, but this is it. And this is what the market is ignoring. And I've said this and I put out in those charts yesterday. And I'm telling you, tick by tick, when this continues up, again, natural gas and crude are both running lately. Crude's had a much stronger run. Crude oil, it has divergence. I believe we're going to get a correction soon, but more so, this is keep an eye on this because the stock market is ignoring this rally in crude oil. And this is a breakout too, by the way. We broke out above this resistance right here. I've been trading in that range for a while. We're at or a little bit above that resistance right there, 78.41. But as I said, the stock market seems to be playing a game of chicken with this whole inflation trade. This is USO. This is crude oil, the biggest component of all the commodities to the consumer price index. It's not just the gas in your cars or the heating oil in your houses or the power plants that are firing on natural gas or any other crude derivative product. It is everything you're buying, everything you're ordering on Amazon. There's a production cost in manufacturing, just about everything. It's energy intensive to manufacture goods. Many are petroleum based products. To ship it, doesn't come from China to your front door on magic wings. It goes over on a ship. Everything that uses a lot of energy. So this is, make no mistake about it. It seemed the markets declared the war on inflation as won. It's kind of like George Bush, read my lips. No, this is this is not going to be. The market's going to have a day of reckoning soon, especially if this continues. Best case scenario for the stock market now, if this can abate, it might support the case for new highs. But if we continue to hold up here, especially if we continue to rally, that is going to just, I believe, bring the market down really hard. And then, of course, let's not forget the other thing. I gave you all this yesterday in the charts I'm watching. It was TNX, 10-year Treasury yield, simple stuff. We're still at, that's your previous high from 2022. We hit it there. We're just below it. There's an uptrend line to watch. Bearish, obviously, if we break it, and that breakdown, turns into a downtrend, and long-term rates start to fall, unless that giant caveat I keep putting in there. And I think that's so important to say. This isn't double speak. This isn't, this is simple. If rates fall on natural forces, just kind of a gentle abatement, and it's not due to a flight to safety from institutional investors that are flocking into Treasury bonds, because when you buy bonds, rates go down. If they do that because the stock market's falling, or they think it's going to fall, and they're selling stocks to move into bonds of safety, that is not bullish for the stock market. Otherwise, we could see a scenario where rates go down, and it would be. But as of now, rates are at multi-year highs. Again, I've covered this many times. You have to go all the way back to 2000. This is the financial crisis, was right here. And the market peaked in October of 07, right there, where rates were today. This is the first time, other than that blip back in 2022 last year, that we've seen rates back to this level. And it's not so much that, okay, they're back to where the last financial crisis was, in the big bear market, 55% plus drop in the S&P and NASDAQ 100. No, it's not about that. It's about this. This is unsustainable. And it's proved to be less detrimental to the economy and to corporations than initially forecasted. And again, it's all about the lag effect. And again, it's been well documented since that a lot of corporations and a lot of individual consumers had plenty of time, long time, to lock in low rates. And so they say we have a ton of corporate debt coming due in the next year or so, and that will be rolling at higher rates. Up until now, corporations' balance sheets have remained strong because they were locked in at those very low rates, just like most homeowners were locked into their low mortgages. And eventually, over time, people die, they have job transfers, they have to move, or they hit financial hardship. They don't want to give up that 3.5% mortgage, but they may be forced to at some point. And that's where the higher interest rates, this is just, again, going to have an impact on the market sooner or later. And you can see the big divergences there. So you want to know my take? I think it coincides, my preferred scenario. Primary scenario is still another leg down the bear market in equities, and we'll probably see the abatement, and we'll see this trend line give way. And I think that will be what I'm talking about, institutional flight to safety, buying Treasury bonds, which then forces yields down, maybe coming in back test. This is our secular bear market downtrend line from the early 80s, 1980, 81, I think it was, when rates peaked, and we've been in a secular bear market since. So that's a breakout. This is kind of my longer term working hypotheses here. It's something along these lines that we broke that trend line. It's clearly we've taken out previous reaction highs, and I still maintain this is the early stages of a new secular bull market in interest rates that will go up over in years to come, maybe even a decade or more. But it's just not going to be straight up. We can't, this rate of ascent is unsustainable. So like any bull trend, you get your corrective waves within, and so that's one scenario there, and that might coincide again with a drop in the equity markets. Or maybe it's for other reasons where just natural market forces bring rates down, and there's all of a sudden an abatement, a little reprieve for the stock market. So that would also you don't want to hear it, but it's just would make sense to me, play into that marginal new high scenario in the stock market with long-term Treasury rates falling down for a while, and then see that leg up like that. And by the way, if any natural gas traders use futures, that's my preferred proxy is just divergent lows, divergent low, divergent low, and divergent low, Rally. I shared this. I believe I shared this one last week. So that's it. And, this is it. So you have this kind of sort of a downtrend line there forming, but you keep rallying off these divergent lows. And overall, natural gas remains in this kind of trading range. It's not a buy and hold thing. Hasn't been for a while, more of a trading vehicle. So there's levels. Oh, let me give you a level right here. Let's see right here. Got a couple reaction highs recently. Several reactions there. Looks good up to at least 285 or so before the next decent reaction. Maybe step in a little bit early if you want to take some profits. Or again, don't forget the daily charts are coming off a big divergent low. There's the potential for another, eventually natural gas to break out of this trading range and really run like it has in the past. Okay, and before I forget, here's the economic calendar this week, starting out with the all anticipated or ever anticipated CPI. That's tomorrow at 8:30. That's going to be followed on Thursday by jobless claims, PPI, and retail sales. It's quadruple witching on Friday, which usually leads to increased volatility, followed by industrial production at 9:15. These are your market movers for this week. So that's why I'm doing this video. I'm throwing a lot out to you. Watch, again, I'm showing you levels to watch, opportunities, but this is where, this is going to be the all of these collectively, really. It's could be any or all of them could be the catalyst for either, set the stage or spark a rally up to that marginal new high scenario, or which is still my preferred scenario, this. Now I'm going to segue into this next chart. So there are quite a few broad-based commodity ETFs and ETNs out there, and the ones that I've highlighted in the past, DJP is one of those. It's very well diversified. I've covered it before many times. It's got a little of everything. Like most of them, energy is the most overweighted component in most of these broad-based, diversified sector ETFs, and that's because energy it's the biggest component in the CPI as well. So that's why I said, corn or soybeans can do what they want to do, but they're not going to move the needle on the CPI nearly as much as, nor does the CPI include raw commodities. It includes finished goods. A loaf of bread, it takes a while to prices to trickle through. So, but there it is. There's what it holds. And then what I've done many times for you in the past, especially over the last year, is I put these lines here. I haven't done, well, we know CPI is tomorrow. Oh, no, the month end. These lines right here, I think you can see them in the video. I have one there. And then the little boxes. They show you the monthly gain. So this was that huge spike in July, and it didn't register, in my opinion. They understated that gain, in my opinion. It didn't flow through. And again, remember, as I just said, CPI does not include the raw commodity products. It includes finished goods, like instead of wheat, a loaf of bread at the supermarket. And that takes a little time. But what you can see here, so there's going to be a lag. However, this has been a very accurate indicator just on itself, if you just take it on face value. And crude does come through a lot faster, by the way, crude oil. So that big spike in crude is going to be reflected in the last couple months. And what you can see here is inflation, or commodities, I should say, peaked. Troughed, back in right in the beginning of June. So you had a big run up in June, but then you ended the month. There was an abatement, a sell-off that took us down there. July was a very hot month in commodities. And so far, if I did the box here, August is going to be right about there. And, holding on. But if you look at, just smooth it out. In other words, take a 3-month average and look at this. This is where we've gone in the last 3 months. From this point here, that's the very beginning of June, to right here, end of August, which is somewhere, you can see August 28th, 29th, 30th, 31st, right there on that candle. So I need to duplicate that line, drag it over here. Where was my August 31st candle? Right there, 1 month, there it is. So now I just take this, and there's my August box right there. Runs from there to there. So that's what we did. And so you can see we're stair-stepping higher. So, the stock market doesn't see it, but maybe I'm seeing something that's not there, but I see a return of the inflation trade. And again, it wasn't random either. There's your uptrend line. It was technically induced. This is what I've maintained all along, and from the beginning, this is the beginning of a new secular bull market, the end of a larger bear market in commodities, and nothing goes up forever. This was our initial primary leg up, followed by a corrective wave that was about 1 year, and put in, just like you had divergent high at the top, negative divergence, you had positive divergence at that low, very clean and clear positive divergence, breakout, and we've been stair-stepping higher since. Okay, so that's that. And last but not least is wheat. Wheat coming off. This is a 3-month chart using hourly candles for ZW wheat futures. I'll give you the wheat ETN in 1 second. Wash, rinse, repeat. Bearish rising wedge with negative divergence. There's a sell signal, either short or get out of your long. You know, it came full circle there. Positive, aka bullish divergence, gave us this rally, which ended with, you got it, divergent high, correction, divergent low. Not a big one, but a rally, and now it's had this divergence been building for a while right here on the indicators, and a little minor trend line could do the trick. I'm not crazy about the downtrend line, it's pretty short term, but that could do the trick and take us up there. There's your target, 642, 661, and we'll call it 662, and then about 704 for futures traders. If you don't trade futures, you can use the ETN WEAT. And same thing, just take that line here, and we had large positive divergence at that recent low. We swing it up, hit that second of 4 targets, and all we've done since is put in a marginal new, ever so slightly lower low right there, and still very, very much have those large positive divergence that have been building now for quite some time right here. There's your divergence lines right there. It's not as if that one didn't play out and trade right to T2. Hit it again there, so that's the level it now needs to pop. So if we can reverse minimum, that would be the next swing target again, but we've already checked it twice, so that should, my guess is, we'll probably power on through there and hit T3. There's more of a zone right here, and then ultimately T4, and quite possibly more. So looks good now. In my opinion, there's a 60-minute chart, divergent low, positive divergence on the 60. Take it with a stop somewhat below the recent lows if you want to keep your stops tight. And I'll have to redo the targets here. That was the last trade. And we even shorted it off that high right there on the site, because we had the negative divergence. And then we had, double top divergence again. Took us down here. So anyways, that's it. All right, let me wrap it up here. Yeah, we'll wrap it up here. And again, watch that economic calendar this week. Watch the financials. Watch the semis. There's a lot to watch right now. And the thing is, I guess the takeaway, looping back to the financials and the semis and some other things, and even QQQ, we're a lot closer to break, or we're a lot closer to those uptrend lines, which would trigger some pretty powerful sell signals, such as those key financial stocks, such as semiconductors and some other things there. So in my opinion, the risk of a downside move, should some of these economic reports go the wrong way for the markets, that's the bigger risk right now, in my opinion. Can't rule out, the fact that we just checked support on a lot of those lines, and maybe we'll see some buyers come in there. So I don't know, maybe bilateral if you want to call it that. But again, the odds change day by day. That's what I try to impress. And I know it's hard to grasp, but you flip on a dime, react. If we take out the trend lines, and there it is in QQQ and all that, those odds, if you want to call them bilateral or equal risk right now, fine, because you're above support. But if you break that support, and you break the comparable support in the financials and in the semis and a lot of those key, leading financial stocks and tech stocks for that matter, then, I think the downside could be pretty quick. All right, let's wrap it up here. I'll get the video out to you, and if I see anything else that stands out, I'll follow up either in the comment section below this video or in a new post. This has been Randy Finney with Right Side of the Chart. Have a great day.